Good afternoon, everyone. Today, myself, CA Manmeet Kaur Khanuja, welcome you all in this webinar being organized by CCLEA and NPO Committee of ICI. It is a pleasure to be a moderator in celebrating International Charity Day today with all of you through this webinar on NPO Incorporation and Management being organized by Committee on Commercial Laws, Economic Advisory and NPO Cooperative of ICI. In a short while, we'll start this webinar. I would like to apprise you about the CCLEA and NPO committee. This committee is focused to encourage chartered accountants to shape strategy and policy that unlocks economic, financial, and social values while combining analytical foresight with commercial acumen. One of the core areas of this committee is to serve the multifunctional task of analysis, knowledge dissemination, inputs to regulators on policy formulation, to develop and publish technical guidance, background materials, etc., and to create awareness for professional opportunities for CAs in commercial laws, economic advisory, and NPO cooperatives. Today, our eminent speaker, CA Professor Lion Suresh K. Mehta. I welcome you, sir, on behalf of this committee. Now, I'd like to have a brief introduction of our speaker today. Sir is qualified as CA final examinations in 1978 and has a meritorious career. He is a partner at MS Suresh K. Mehta and Company Chartered Accountants since 1978. He has also served as an ex-lecturer at Modern College of Arts, Science and Commerce and at Garware College of Commerce, Pune. He is also examiner for reputed professional examinations. He has received numerous awards for his professional and social contributions. Professionally, he has contributed 402 articles of professional social interest in various periodicals. He has delivered around 385 lectures at various professional seminars within and outside India. Further, he has written 7 books on auditing, trust laws, and etc. Socially, Sir has also provided his efforts in implementing national character development scheme since 1998. Sir, over to you.
Thank you. Shall we start now? Shall we start?
Yes, sir.
Yes, sir. Yes,
Am
sir, we
I
should start.
audible to all of you? Am I audible?
Yes, sir.
Yes, sir, you are.
The chairman of our NPO committee, Lion Abhayji Chhajar, Shri Jain Manmeet Kaur, and my professional brothers and sisters. सबको सस्नेह जय Shri Krishna. In Maharashtra, today we are also celebrating the Ganesh festival. I send my greetings to you on this auspicious occasion of Ganesh Utsav in Maharashtra. Today we have the Teacher's Day too. This Teacher's Day I look upon as a special day for chartered accountants, especially those who are in practice. It is for the simple reason that these chartered accountants are training the future chartered accountants, and therefore all the practicing CAs training articles are also to be the teachers for our incoming CAs. I send my greeting to all of you on this auspicious occasion also. With this brief introduction, I will now move to my topic, management and incorporation of NPOs. At the outset, I take this opportunity to put on record my extremely heartfelt, informal and sincere thanks to the organizers for giving me this opportunity to share some of the thoughts on the topic of incorporation and management of the NPOs. Friends, the name of the topic is Incorporation and Management of NPOs. This is a very innovative topic for me as far as my professional career of around 47 years of practice is concerned. When Mr. Vasudev spoke to me about this particular topic, I deliberately suggested him this particular topic. So far as this topic is concerned, we will be handling two separate issues with reference to the NPOs. One is incorporation of the NPO and second is the management of the NPO. These are the two different steps in the life of any NPO. Incorporation is giving a birth to the NPOs and management is nursing and growing the NPOs. In our today's lecture, we will be discussing some primary issues, but those primary issues are substantially important from the point of view of incorporation of the NPO as well as management of the NPO. My more thrust in this lecture will be on conceptual clarities and handling the issues. Those are extremely important in our day-to-day practice as compared to the existing statutes. Incorporation versus registration. Friends, conceptually, there is a difference between an incorporation and a registration. In our day-to-day practice, we take incorporation as equal to registration. But conceptually and statutorily, there is a tremendous difference between the term incorporation and the term registration. Name of our topic is incorporation of NPOs, and therefore we are touching upon the issue what is the difference between an incorporation and a registration. Friend, when we study the provisions of the Companies Act, we have an opportunity to go through the definition of a limited company. Maybe it is a public limited or a private limited. Regardless of the type of a company, the definition is common. Joint stock company is an artificial person created by law having a common seal and a perpetual existence. There, the thrust is on creation of an entity which is not of a natural nature. That is non-individual entity, that is an artificial entity. First part of the definition of a company goes like this only. Joint stock company is an artificial person. So, the incorporation is always with reference to an artificial entity, non-individual entity. If we go through the provisions of various statutes, maybe like the Societies Registration Act, maybe the Companies Act, maybe the Maharashtra Public Trust Act, we find the terminology used as incorporation of a trust, incorporation of a company, incorporation of a society, and so on. So the thrust of this law everywhere, so far as an incorporation is concerned, is on the artificial entity, not an natural entity. So, friend, this is so far as the incorporation is concerned. By incorporating an entity under a specific regulation governing that particular entity, we bring into existence that entity which is artificial one. As against this, we have the term registration. We loosely use the word registration for registration of a trust, registration of a company. But conceptually, with reference to formation of a company, as I told you earlier, we use the term incorporation. The issue is now what is meant by registration. We have in India an act called as Registration Act 1908. There we find the term registration. And this registration term is used in the context of the various documents those are registered. Take the case of a sale deed for purchase or sale of a land or building, deed of partnership, an affidavit, a power of attorney, and so on. In our day-to-day life, we entered into so many agreements. Whenever the Registration Act or the Stamp Act requires the document to be registered, that particular process is called as the registration. So conceptually, incorporation refers to bring into existence an entity which is not natural, which is artificial. So far as registration is concerned, registration refers only to the documents, those are required to be registered, maybe under the act like Registration Act or the Stamp Duty Act. This is so far as, friend, the registration and incorporation is concerned. Now I'd like to touch upon very important issue before one proceeds further to get his NPO incorporated. Out of some zeal, one approaches us, out of some emotions, he approaches us to help him in incorporating a trust or a society or a company. Whatever may be the form of organization, Section 8 company or a society under Society Registration Act or a trust under Maharashtra Public Trust Act. One needs to understand large number of issues, those are required to be handled or answered while managing the NPO, a charitable trust, a society, or a limited company. And therefore, before we touch upon the important issues so far as an incorporation of an NPO is concerned, I would like to touch upon the vital issues, those are required to be taken into account while incorporating an entity, before incorporating an entity. First and foremost is the financial stability of the NPO we propose to establish. As the promoter, he is required to ensure that there is a very strong self-sufficient infrastructure that will be made available to run the NGO at least on break-even point basis. Basically, the NPOs are established not with the object of making money. While this is a naked truth, it is also equally important to see that after an entity is incorporated, it doesn't face any financial crunch after it is incorporated. Therefore, as the practicing chartered accountants, I think it is our solemn duty to bring it to the notice of the promoter concerned to ensure that the baby in the form of NPO will be financially strong enough to have its break even achieved right from the first year. As a practicing CA, I have an experience that people come with some emotion, get the trust incorporated, and after some period, because of financial crunch, they find it difficult to run the day-to-day affairs of the NGO. And therefore, friends, it is my sincere advice to you that before we incorporate any NPO, we advise the promoter who has come to us for the assignment of incorporation of NPO to advise him that he ensures that there will be strong infrastructure, financial and non-financial, to ensure that the NGO runs smoothly in the future on at least the break-even basis. Apart from the financial stability issue, another important issue in the life of an incorporated entity is the succession planning. Friend, this succession So far as the succession of individual property is concerned, in our country, we have got an act called as Succession Act. This is taking care of our personal assets. Nowadays, with privatization and globalization, we are talking of succession planning so far as businesses are concerned. Personal property is subject to succession by means of Succession Act or by means of a will. So far as succession of a business is concerned, businessmen many time have the succession plans ready in their minds. Similarly, the succession planning for NPOs is also equally important. There are NPOs which are managed by a family, and there are some NPOs managed by the public at large, depending upon the type of membership. Before proceeding further to incorporate any NPO, it is extremely essential for the promoter to ensure that after his acting career is over, somebody will be there to stand in the shoes of the promoters. It is my experience, especially in case of family trust, working for society, not for the benefit of members of the family, but working in general for the general public, that with this globalization and privatization, next generation is moving either out of India or is moving out of the family businesses. This generation may not necessarily be interested in continuing the entity NPO which we have established, and therefore, apart from financial stability, I think it is extremely essential for us to advise the promoter to have the succession plans ready after his working career is over. Why do we advise this? Because nursing of a running of an incorporated entity is like nursing of a child and nursing of a special child. Special child is basically our duty. Duty in the sense it is a responsibility, and you are required to keep a full-time attention on this special child. Similar is the case with the NPOs. Large number of duties are cast on the shoulders of the promoters, and in case there is any failure, he is subject to large number of legal notices. What sort of compliance is required to be done so far as the NPO is concerned? That is narrated by me in this slide. First and foremost issue is keeping and maintaining accounts and other records. Deliberately, I will talk on this issue in detail. Firstly, so far as accounts are concerned or other records are concerned, you are firstly to keep the record and then maintain the record. Friends, at the beginning, we touched upon the issue incorporation and registration. Similarly, as far as accounts and other records are concerned, we are not required only to keep the accounts, but we are also required to maintain the account. As far as information technology generation is concerned, keeping of accounts and keeping of records implies making a data entry on the system. That is, suppose you are making some accounting entry, then what you do is that whatever accounting software you have got, you make an entry, say for purchase of books, purchase of equipment, and so on. These making an entry on the accounting software is keeping of the accounts. So far as manual records are concerned, what you do is that you have a cash book, you have a bank book, you have a journal, you have purchase register, you have sales register. Depending upon the transaction involved, you make an entry in the concerned book, cash book, bank book, purchase register, sales register, journal. And subsequently, that entry is manually transferred to ledger, followed by trial balance, profit and loss account, and balance sheet. So far as mechanized accounting is concerned, no sooner you make an entry of the first step, say purchase of books, automatically finally the P&L account and the balance sheet are prepared. This is so far as the keeping of accounts is concerned. You are making an entry on the software, and software takes the care of preparing the final account, income expenditure account, and balance sheet. Maintaining of the accounts and maintaining of the other records is the next part after keeping the account. After you have an entry on the computer, maybe stored on cloud basis, you are required to keep the backup of this particular entry, this particular balance sheet, or this particular data. This keeping backup of the data depending upon the period applicable to the nature of entity, you are to preserve this data for that particular period. And this preserving of a data for that particular period is maintaining. So friends, laws are very clear. Laws prescribe you should keep the record, you should keep the accounts, and after keeping, you should maintain the account. So maintaining is like preserving the record. Maintaining is like preserving the books of accounts, and keeping is the first step before maintaining the accounts and before maintaining the records. If you go through the responsibilities so far as keeping of accounts and maintaining the accounts and records, the statutes use different terms. Statutes use the terms you should keep and maintain the records with reference to receipts, payments, expenditure, income, assets, and liabilities. Friends, as the professionals, we know by imposing a responsibility on our shoulders to keep and maintain the records in relation to these six items: receipts, payments, income, expenditure, assets, and liabilities. A very heavy responsibility is required to be shouldered by us. We know that every income is a receipt, but every receipt is not necessarily an income. Take the case of maturity of the fixed deposit. No doubt it is a receipt, but it is not an income. It is conversion of one asset into another asset, from a fixed deposit to savings account or the current account. So what the law prescribes is that you should maintain and keep the record with reference to receipts as well as assets. As far as the example of the fixed deposit is concerned, we saw that in respect of maturity of a fixed deposit, which is an asset, it gets converted from fixed asset into a current asset, fixed deposit to bank account. That it is converting one asset into another receipt, but that is through the receipt side. But that is not our income, unless and until some interest income is also included in this receipt. Similarly, is the case with the payment. We know that every expense is a payment, but every payment is not expense. When we make a fixed deposit, it is a payment, but it is not an expenditure. So, by using these six terms at a time, receipt, payment, income, expenditure, assets, and liabilities, these statutes are prescribing Large number of books of accounts and other records, those are required to be maintained. Friends, I referred only to the regular books of account, those we are maintaining. That is cash book, bank book, ledger, journal, purchase and sales register. Apart from this, in day-to-day practice, we are maintaining large number of other books of account also. Take the case of salary register. Take the case of fixed asset register. Take the case of fixed deposit register. All these records are forming part of the accounts directly concerned with your balance sheet. There are also non-accounting records which a NPO is required to maintain. Another record which is very vital for an NPO, we will start with is its articles of association, memorandum of association, and the incorporation certificate. Your objects, your day-to-day operations are controlled by your memorandum of association and articles of association. And these both the documents have got very strong effect on day-to-day functioning of the NGO. So far as other records are concerned, starting record is the record of registration certificate, your memorandum article. Another important other record with reference to your books of accounts and with reference to management is your proceeding book. You have two types of proceeding books generally. Proceedings of the members of the managing committee or the board of trustees and proceedings of meetings of the general body. With reference to these meetings, we are required to maintain large number of records. Initially, the notice of the meeting, then proof of service of notice, proof of attendance of the members at the meeting, and finally the proceeding book. All this is forming part of the other records. As the promoter, he should be made aware of the fact that apart from keeping and maintaining regular books of accounts, you are also required to maintain large number of other records. Apart from this, the promoter should be made aware of furnishing of various returns, forms and statements on periodical basis to the various regulators. Depending upon the form of organization, we have got large number of regulators. Any NPO is subject to the control of Commissioner of Income Tax. Maybe in some cases, this NPO may be subject to a control by the Ministry of Home Affairs at New Delhi. This I am talking in the context of Foreign Contribution Regulation Act. Otherwise, so far as an NPO is concerned, Commissioner of Income Tax is coming into picture in a number of cases that we will handle separately. Apart from the Commissioner of Income Tax and apart from the Ministry of Home Affairs at New Delhi, regular regulator of that particular entity, NPO, is also coming into picture. If you have incorporated your entity as a Section 8 company, then Registrar of Companies will be your regulator. If you have formed a society under the Societies Registration Act or a public trust in Maharashtra, I am talking about under the Maharashtra Public Trust Act, or in Gujarat under the Gujarat Public Charitable Trust Act, the charity commissioner, say in Maharashtra or say in Gujarat, will be the regulating authority so far as this entity is concerned. And depending upon the number of regulators, you will have to file the number of reports, number of forms, and number of statements. So far as meetings are concerned, your meetings and accounts are concerned, you are required to furnish on regular basis to your regulator, firstly, the annual audited accounts, auditor's report, management report, and report of changes in the management. This is so far as the regulator is concerned. Depending upon the facts of each case, there may be some additional reports, forms, and statements. Those are required to be submitted to your regulator. As far as the Income Tax Act is concerned, you are required to submit large number of forms, reports and statements to the Income Tax Department. Illustrative list of such documents I have given here in order of date. Up to 31st of May of each year, you are required to submit the donation statement. By 31st August, you are required to submit form number 9A or form number 10 or accumulation of your income if you are covered by the provisions of section 2023C or section 11 and 12. Form 10B or 10BB depending upon the type of entity you are covered. 10B, friends, you are aware when your turnover is above 5 crores or when you have got foreign contribution. As far as management of the NPOs are concerned, though not necessary, but I would like to again highlight for the information of some of the, especially the younger members, that Form 10B is not applicable only to the trust having collection above 5 crores, but there is another situation in which case, even if your collection or your income is below rupees 5 crores, you are required to submit the audit report under Income Tax Act in Form B. And these two cases are: one, if you have got a foreign contribution. As far as the present position in the Act is concerned, or even in the new Act 2025 is concerned, both the acts do not prescribe any monetary limit so far as the foreign contribution is concerned. Even if you happen to receive $1 foreign contribution, you are required to get your books of accounts audited under Form 10B. What is meant by foreign contribution is defined in Foreign Contribution Regulation Act. Foreign Contribution Regulation Act says foreign contribution that you have received factually and physically. And it further says foreign contribution will also include the interest you have received on your foreign contribution bank account. I would like to go to the Foreign Contribution Regulation Act provision. Friends, all of you are aware. Now the Foreign Contribution Regulation Act requires that every NPO receiving foreign contribution must mandatorily open its account with Delhi branch of State Bank of India. And then it can withdraw the money from that account. So once you open an account, it is quite likely that this year you may not get some interest. But in the next year, without receipt of any physical financial contribution in foreign currency, like say dollar, franc, whatever the case may be, yen, whatever the case may be, if you continue to receive the interest on the foreign currency bank account you have opened under foreign contribution regulation in previous year, then you are required to make an audit report in Form 10B and not Form 10BB. One more precaution so far as Form 10B is concerned. Your turnover is below 5 crore. Your receipt as a foreign contribution is zero. But though there are large number of restriction on application of the income of NPO, with proper procedure, you have applied any money outside India, then also you are required to get your books of accounts audited and get the audit report prepared in Form 10B. So far as Form 10B is concerned, apart from regular financial contribution in foreign currency, if you receive without foreign currency contribution an interest, or if you apply your money outside India, then you are required to get the books of accounts audited and get the audit report prepared in Form 10B. After audit report, you are required to file the income tax return, and also depending upon the period expiry of the period of your registration and approval under Income Tax Act 1961, you are required to make the applications in Form 10B for registration or approval, as the case may be. These are the large number of records. Those are required to be submitted to a regulators. I was discussing the issue. The promoter to be made aware of the responsibilities after he gets his entity incorporated. After he makes up his mind, in the light of all these situations, that he will be required to hold the meetings regularly, he will be issuing the notice, he will be keeping the record of service of notice, attendance of meeting, proceeding books, and all other records. Those are discussed by us at length. He may make up his mind to get his entity incorporated. And now come the issue of incorporation. The issues I was discussing so far were concerned with pre-incorporation stages. And now we are starting with the stage of incorporation, and then we will talk of some of the important issues so far as post-incorporation period is concerned. So we will be talking about the three positions: pre-incorporation, incorporation, and post-incorporation. Now coming to the issue of incorporation, we prepare the articles of association and memorandum of association. Maybe depending upon the form of organization you are choosing, you may be preparing a trust deed, whatever the case may be. If you are forming a Section 8 company under the Companies Act 2013, or a society under Societies Act 1860, or a public charitable trust under Maharashtra Public Trust Act, or under Gujarat Public Trust Act, or depending upon your local state act, you would be preparing the memorandum of association as well as the articles of association, or in some cases the trust deed. First important point, as the professional, we are to keep in mind is that, and we are already aware of it, that is, we are supposed to avoid the copy paste formula. I will deliberately touch upon a case I was required to handle because of this copy paste formula. Extensive use of information technology. What happened was that there was a public charitable trust registered in Maharashtra. Copy paste formula was used, and in the membership clause, it was provided that the membership of this, I am not talking about the purposes, objects, I am talking about the membership. There is no restriction on giving the membership. There is restriction on objects of the trust, so that you are covered by section 1023C or section 11 and 12. So there is no restriction on giving membership. You can give membership to a limited number of persons. Income Tax Act doesn't object to that. Income Tax Act objects only on the class of beneficiaries. So that class of beneficiaries we will talk about afterwards. I was citing the example of membership copy paste formula. This case was handled by another professional. For some reason, I was replaced by for that particular outgoing auditor. So after obtaining the consent from the previous auditor, I obtained a copy of the registration certificate and the trust deed, because that particular entity was formed as a trust, not as a limited company under 2013 Companies Act or Old Companies Act 1956. When I went through that, I found that the membership of that particular entity was restricted to the members of a particular religion. I would not have objected to this terminology also. But what in practice happened was that the management was coming from a religion, say particular religion A, and the provision was there with reference to religion B. And this was a contradictory provision, whereas the management was coming from religion A, the provision in the trust deed was exclusively reserved for membership of members of religion B. I brought this to the notice of that gentleman. And then I asked him, did you not read this particular trust deed before forwarding it to the charity commissioner for registration? He said, sir, it was a copy paste formula. So friends, based on my this experience, though all of us are taking this care, I would like to emphasize that right from the first sentence to last sentence, we must be very careful so far as the drafting of article memorandum or the trust deed is concerned. The language used should be very, very simple and should be very, very elastic. And the provision should be very simple and elastic. What is meant by elastic and what is meant by simple, that we will see in the next slide. While drafting the objects clause in your memorandum or the trust deed, so far as section 11 and 12 entities are concerned, or section 1023, which is now out of existence in the new act, I would strongly recommend you to add all the charitable objects as are given in section 215 of the Income Tax Act 1961, which is going to go out of existence from 1st of April 26, and section 223C of Income Tax Act 2025. If we are incorporating up to March 26, section 215, and if we are going to incorporate after 31st March 26, as per section 223 of the recently passed Income Tax Act 2025. Even if your basic object is, say, educational, sometimes we carry out other charitable activities also. So, while our principal object and the object incidental to the principal object may be educational, while drafting our memorandum object clause, I will recommend you to add to your other objects all the remaining clauses. Suppose yours is an educational institution, and taking into account the provisions of section 215, I would like to add in other objects relief of the poor, yoga, medical activities, preservation of environment, preservation of old entities, and any other object of general public utility. So that even if apart from educational entity, educational activity, you happen to carry on some any other object, Commissioner of Income Tax should not object to your carrying out this activity. Why do I say so? I have got in my mind the provision 115 TD of accredited income. It says when you carry out the activities which are not allowed by your memorandum or by your trust deed, you would be liable to 115 TD and to cancellation of your registration or approval. And after your registration approval is cancelled, it is likely that you may be invited to face the music of 115 TD. Therefore, friends, I would suggest you, if you are setting up an educational institution, why do you have a principal object as educational? in your other objects while incorporating this particular institute, maybe as the company or maybe as a society. In your other objects, you add the remaining 7 clauses: relief of the poor, yoga, meditation, preservation of environment, preservation of monuments or antique items, and any other object of general public utility. It will not be out of place to mention here what is the difference between the principal objects and objects incidental to the main objects. In day-to-day practice, we find that in a charitable hospital, you have a medicine shop. Primarily, selling of medicine is not the main object of the hospital, which is run on charitable basis. But for the purpose of achieving its main object of medical activity, making medical life very easy for the patients, what many hospitals do is that in their premises they open the medicine shop where large number of medicines are available. So this business is not the business in regular sense. This is the activity which is incidental to the main activity, and therefore this will also not be covered by any other item of general public utility because it is directly concerned with your principal object. It will be covered by the incidental object to the main object, and therefore it will neither fall in other object nor any other object of general public utility. This is so far as one of the drafting clauses of memorandum and articles is concerned, your objects clause. As a measure of abundant precaution, keeping in mind the extensive use of artificial intelligence and information technology while drafting our object clause, I would also recommend you to add some of the additional clauses that the benefits of our trust will be available to the beneficiaries throughout India or throughout your local area, regardless of one's caste, color, creed, religion, language, abode, etc. Though this is not the requirement of presently 215 or 223 of the new Act, this particular subclause will be giving a lot of weight to your principal object of charitable nature. When you say that my benefits are not limited to the members of any particular caste, any particular creed, any particular community, religion, language, or abode, it clearly implies that it is available to any person in India so far as your local area of jurisdiction is concerned. I would also like to highlight upon you to add to your articles and articles object clause that there will be no benefit specifically provided to the specified person. There are large number of restrictions in section 13 of the present Income Tax Act and section 12 also so far as the benefits made available to the specified persons are concerned. And therefore, while incorporating a company, apart from widening the object clause in the as I explained in the earlier case, I would like to also to add to your object clause that the benefits of your trust will not be made available to the specified person in an partial manner. I mean, either these benefits will not be made available to them at free of cost or at the concessional rate to the specified persons. What is meant by specified person is defined in the Income Tax Act. Specified person, some long list is given in section 12. Specified persons include the founders or the authors of the trust, the present trustees, relatives of the founder, author, and trustees, persons who have made substantial contribution, relatives of these persons, and members of the HUF, if the HUF is one of the founder or the author. So far as the drafting of your object clause is concerned, apart from the other facts, I would like also to add these two small clauses. As far as area of operation is concerned, I would also strongly recommend you to see to it that area of your operation is limited to any place in India. I would like to narrate a very interesting story of a very well-known newspaper in Pune, which faced a lot of music because of its operation outside India. What happened was that an earthquake took place in Nepal, and purely on humanitarian grounds, purely as an object of charitable nature, the charitable trust set up by this particular newspaper in Pune extended financial assistance to the citizens of Nepal. No doubt it was humanitarian, but there was a small lacuna. This activity was carried out by that particular newspaper without the approval of the Central Board of Direct Taxes, CBDT, which is administering the Income Tax Act. If you take the prior approval of the CBDT and then you apply outside India, CIT will not take any objection to that. And everywhere in section 1023C, 11, 12, 13, 80G, you find that your activities are required to be restricted to India only. And therefore, while drafting the object clause, it needs to be specifically mentioned that in no case the area of operation shall go beyond the boundaries of our country. Maybe say you have limited your object to Maharashtra state or say to Kashmir, no problem. As far as your objects are limited to the territorial parts of India, the income tax department will not object to that. So taking into account the long-term journey of our trust, it needs to add it to the object clause. So far as an incorporation is concerned, that area of your operation is limited to the geographical part of India. No special benefits either at free of cost or at considerate are extended to the specified persons, and benefits are available to every person in India. I don't say Indian citizen, I say any person in India. And regardless of his caste, color, creed, religion, language, abode, etc. I would also recommend it to add while drafting your object clause or the in memorandum or trust deed that the terms those are not used in this particular object clause in memorandum article or trust deed should be taken equal to the terms used in the general clauses act. These are the basic precautions those are required to be taken while in drafting the object clause of the memorandum of association or object clause of the trust deed of a society or a trust under the Societies Act, Registration Act, and under the Bombay Public Trust Act. Next, again, going to the membership issue, incorporation issue. Now I am coming to the articles of association. Trust deed normally contains both the things together. Your name, object, liability, association, subscription, all clauses are contained along with your day-to-day provision in trust deed. Trust deed is just, to my experience, is memorandum of association and articles of association. Whatever little study I have got, I find that in case of a society and in case of a company formed under Companies Act 2013, you are required to have memorandum and article separately. But so far as my experience in Maharashtra and Gujarat is concerned, I find that a trust is incorporated while combining together the memorandum and articles of association of an entity together. So in Maharashtra, in some cases where the entity is not registered under the Companies Act, we incorporate a company, an entity as a trust by combining the memorandum as well as article together in the form of a trust deed. While drafting the articles, And now the trust deed also. We sometimes make a provision for the rates of membership fee. How much should be the membership fee? How much should be the entrance fee and so on. Sometimes it becomes necessary to increase the rate of membership fee and the rate of entrance or other fees those you are levying. If the provision is made in the trust deed or the articles of association specifying the rate of fee, membership fee, entrance fee or any other fee, and you decide to increase it over a period of time, it becomes necessary to get the articles of association as well as the trust deed amended. And amendment of a trust deed or amendment of articles of association is a very time-taking, laborious process. Apart from calling the special meeting of the members, you are also required to give intimation to your regulators, maybe Charity Commissioner in Maharashtra, maybe Registrar of Companies under the Section 8 company scheme. In order to avoid this, I recommend that in place of prescribing the rate of fee, we will just say the membership fee as decided by the general body or as decided by the managing committee from time to time. So, by merely passing a resolution in the meeting of the general body or in the meeting of the managing committee or in the meeting of the board of directors to whom the authorities are given to prescribe the rate of fees, you can just uh, prescribe the new rate of fees. So, while drafting the clauses with reference to membership fees or other fees and entrance fees, I would strongly urge you to not to mention the amount of fee or the rate of fee, but provide for a clause conferring a right, maybe on general meeting or maybe on the board of trustees or board of management, managing committee to prescribe the fees as they deem fit from time to time. This is for the purpose of administrative convenience and to avoid submissions to the regulators. So far as membership fee is concerned, we have discussed at length, but we will also talk about the types of membership. We find, especially in case of trust, a large number of memberships. Large optional, life member, associate member, sympathizer member, annual member, simple member. Friends, at the beginning, I have commented that the memorandum article and trust deed should be very simple and very elastic. So, by making a provision of large number of memberships, in my considered opinion, we are making these documents little inelastic. So, my thrust will be on minimum possible membership. I will strongly urge not to have the annual membership, but to have the life membership for the simple reason that you cannot, in practice, even if you have got sufficient office infrastructure to ensure recovery of the fees from annual members, and then follow up, cancellation of membership, rights of members, all these issues creep in. So, friends, my suggestion to you will be you have minimum possible classes of members so far as your membership is concerned. Many times, operating procedures I have seen given in the memorandum as well as the articles, the trust deed. For example, The bank account will be operated under the signature of any two of the directors. To my mind, this is not a part of articles of association. This is not a part of trust deed. This should be left to the managing committee or to the board of trustees. So, issues of day-to-day administration, if possible, may be avoided by inserting them in the memorandum and article and trust deed, and they may be left to the day-to-day convenience of the managing committee or the general body. As against this, I will also recommend, so far as management of the NPO is concerned, to have a standard operating procedure framed for each and every activity. We are talking of succession planning. For the succession planning, I talk in terms of human beings, also in terms of staff. So whosoever are there to succeed, maybe as an employee, maybe as members of managing committee or board of trustees, a separate standard operating procedure in respect of each activity may be prescribed separately outside your articles and trustee. I will give you one example. You want to purchase a fixed asset. So what will be the financial power so far as purchase of an asset is concerned? This is a part of your standard operating procedure as to what will be the financial power of the chairman to incur the revenue expenditure, what will be the power of the chairman to incur the expenditure of a capital nature, what will be the power of the managing committee to make the purchases for fixed asset, maybe for revenue nature, and so on. Apart from this, I would also recommend you to have various internal forms as a part of convenience, maybe membership form, transfer fee form, then resignation, notices of meeting, as you have, say, in case of a Cooperative Societies Act. So these are various procedural aspects, those need to be taken into account as a part of efficient management while incorporating a company. While managing the membership fee, it is my experience, either in case of a trust or in case of a cooperative society, though not a topic of discussion today, I have found in some cases that the membership fee, when paid for by the prospective member, is accounted for in the books directly as the membership fee and entrance fee. After his admission as a member, he becomes a member. Merely by paying the entrance fee and membership fee, he doesn't become a member. In between these two, there is an approval by the managing committee to his application for membership. So technically, so far as membership fee is concerned, like the membership of a limited company in case of NPO, in case of first issue, the management must ensure that whenever a prospective member deposits his subscription with entrance fee, the amount is credited not to the subscription account, not to the membership fee account or to the entrance fee account, but initially to the application money account. Friends, you are aware, subscription received or entrance fee received is a part of your revenue nature income. But application money received is not your income. It is a liability of the short period, current liability. unless and until your management accepts your form, he doesn't become a member, and therefore, up to the time the application for membership is not approved, the application money should be kept in under the head current liability, under the head application money, or you may give subscription reserve, whatever the case may be, under the head current liability. And upon approval of application for membership of your NPO, then only this money should be transferred after the date of the meeting from application money account or the share subscription reserve, whatever the name you give, to your entrance fee account and the entrance fee account. And finally, and then entry should be made in the register of members. So this is so far as the incorporation of a trust is concerned. After incorporation, we are required to hold large number of meetings. As I told you at the beginning, so far as notice of meetings are concerned, and now I am touching that particular issue. We have four important parts of holding of any meeting. Firstly, the notice of meeting. Secondly, the service of the notice of meeting. Thirdly, actual conduct of the meeting. And finally, the proceedings of the meeting. I will talk from management point of view on each of the four items, though you are thoroughly acquainted. For this will be an addition for some of the especially new members. Firstly, we have the notice of meeting. The notice of meeting must contain day, date, time, and place where the meeting is scheduled. Day, date, time, and place. In this sequence only, the notice should be issued. You should say that the meeting of the members of the managing committee is arranged on Friday, that is day 5th September, that is 2025, that is the date, at 5:30 p.m., that is time, and at the Noida office of the Institute of Chartered Accountants of India. This should be the sequence of the day, date, time, and place of your meeting. After day, date, time, and place of meeting, the agenda must be circulated along with the notice of meeting. In case of NPO, normally the first two items on the agenda are the approval of the minutes of the earlier meeting, maybe general meeting, maybe annual meeting, depending upon the type of meeting. And second item on the agenda normally is approval of the accounts from beginning of the financial year to a month ending before the date of meeting. Normally these two items are there, and I recommend these two items to be kept on the agenda of each meeting: approval of the earlier minutes and approval of the accounts up to the month end of the earlier month. Then, thirdly, there should be date of, secondly, the contents of the notice, then there should be date of issue of the meeting. On that day, notice, there should be the date of issue of the notice, and finally, notice should be signed by the person who is authorized to sign the note. Friends, we know in income tax we have faced large number of cases where the notice was issued by the wrong person and proceedings were passed. Similarly, as a measure of abundant precaution, we must see to it that the notice is signed by the person who is having the authority to sign the notice. Maybe that this is the authority given by the authority fixing the meeting. Suppose the meeting is fixed by the managing committee. Then managing committee will say that the next notice of meeting will be issued under the signature of the secretary or the chairman, whatever the case may be. After issuing of the notice this way, another extremely important point is proof of service of notice. You must have a proof of service of notice. Friends, As the tax consultants, we are well aware of two important terms so far as the issue of notice, so far as the notices under Income Tax Act are concerned. We know under Section 143(2), many cases have gone against the department when notice was only issued but was not served on the SSC. Issuing is like signing the notice, but service is handing over the copy of that notice to the recipient. So here I am saying proof of service of notice on the persons who are entitled to receive the notice of meeting. You must have a proof that the notice of that particular meeting was served on the recipient who is entitled to receive it. Then there should be an attendance register to prove that the meeting was actually held, and finally it will be followed by the proceeding books. So this is so far as the notice of meetings are concerned. I would strongly recommend you to pass the resolutions, maybe in the general meeting or maybe in the meetings of the managing committee. The important resolutions so far as framing of policies are concerned, so far as financial powers are concerned. As far as Income Tax Act is concerned, I would also recommend you to have the resolution before filing Form 9A or 10, before filing 10B or 10BB in the minutes of the managing committee, because this is not the issue of the general body, this is the issue of the day-to-day management. So managing committee meeting should have the resolution for forwarding Form 5, Form 9A or 10, Form 10B or 10BB to the income tax department. So far as management is concerned, I will now touch upon some accounting issues. Friend, we are traditionally keeping all the accounts, but this issue came to my mind when I was making an application for registration and approval in Form 10AB. Form 10AB, apart from another large number of queries, is seeking an information with reference to all the lands, those are held by the applicant, and all the buildings, those are held by the applicant. Because of this Form 10AB, as far as my clients are concerned, we have now started bifurcating the accounts of immovable properties under each head separately. Now the issue of written down value is bound to be that, I agree. But subject to this small limitation, I recommend that as a measure of sound internal control and as a measure of sound disclosure practices, in your ledger itself, whatever may be the accounting software you are using, you have a separate ledger account for each land separately and for each building separately. We all are aware of educational and medical institutions which are having their immovable properties scattered over practically India. Large medical and educational institutions. They have large number of plots either bought by them or leased to them by local authorities or by the central government or the state government, and also they have got their own buildings. Keeping in mind the issue of written down value, the written down value issue will not be applicable so far as lands are concerned. But so far as land and buildings are concerned, forgetting the issue of written down value, I recommend to have the immovable property ledger divided into each separate ledger account for land, each land and for each building. So far as lands are concerned, I would recommend you to add in the ledger name of the land itself survey number, location, and date of purchase of that particular land or date of lease of that particular land. Same will be the formula applicable to the building. Maybe the flat number or the house number. If it is a flat, then floor number, name of the building, location, survey number, and the date of purchase. In both the cases, I have referred to the date of purchase, or maybe in case of land, date of lease. This is just I am recommending to ensure that there is 100% identity between the data we give to the income tax department under Form 10AB and the data that is available to us on our ledger account so far as approval under Income Tax Act is concerned. We also have the fixed deposit ledgers, fixed deposits made from time to time. Like land and building, I would strongly recommend to the management in post-incorporation period. All these accounting issues I am handling in post-accounting period. Like that membership issue I dealt with, then land and building I dealt with, now I am dealing with the fixed deposits. I would recommend you to keep a separate ledger for each deposit, specifying the bank in which it is maintained, the branch of that bank in which it is maintained, the name of the account, the period for which the deposit is maintained, and the rate of interest, etc. As far as our practice is concerned, what we are doing in our offices is that we are asking our clients to do is that so far as a fixed deposit is concerned, we start with the year, then the month, and then the date. So in place of DD, MM, YY, we go YY, MM, DD, so that all the deposits come strictly in order of date of making of the deposit, even if they are closed subsequently. So far as fixed deposits are concerned, taking advantage of this information technology, we can have the fixed deposit ledger having year first, then year in 4 digits, month in 2 digits, then date in 2 digits, and finally followed by bank, branch, and the account number and the period or the rate of interest. This is so far as another accounting issue like membership and immovable properties are concerned with reference to fixed deposit. One more accounting issue, post-incorporation period, so far as NPOs are concerned, from the point of view of management. Reconciliation of depreciation. Friend, we are aware there are different rates of depreciation. Those are there under the Companies Act and those prescribed in income tax rules. Further, we have a situation where we are required to prepare the books of accounts either say under the Companies Act or say under the Charitable Trust Act. There the rates of depreciation differ as say Companies Act and the Income Tax Act. And in this situation, we are required to make the depreciation depreciation reconciliation in our day-to-day practice, and that is what we are doing in case of a company Section 8, so far as the Income Tax Act and Companies Act are concerned. But now Income Tax Act is posing one more challenge before us, so far as management is concerned. So far as companies incorporated governed by Income Tax Act are concerned, Section 1023C and Section 11 and 12. Nowadays, Section 11 and 6 prescribe that the depreciation will be disallowed with respect to the assets which are claimed as application in full. Take the case of a hospital. You have purchased a life-saving device, say ICU unit machinery. Cost is 5 lakhs. So without waiting for rate of depreciation, maybe 15%, 40%, depending upon the rates prescribed in the Income Tax Act, you are allowed to claim these 5 lakhs as the application on the objects of trust. The moment you claim this 5 lakhs as application on the objects of your trust, from this year, at no time in future, up to the time this asset remains in your books of account, you are not allowed under section 11(6) of the Income Tax Act to claim any depreciation. Now, this is one more issue. Firstly, the reconciliation between depreciation under Companies Act and the Income Tax Act, and now disallowance under Income Tax Act. So, we will have to reconcile the depreciation on assets which we have not claimed as an application and depreciation on assets which we have claimed as application under section 11 and 12. And so far as section 11 application is concerned, in future the doors of claiming depreciation are closed. Under such situation, we are required to have separate two-tier table of depreciation. I would like to cite an interesting story for the information management and also for the information of our colleagues. We will take one small case, that 5 lakhs machine with which we will dealt with just now. We will for a moment assume that without claiming this application of rupees 5 lakhs, your income, 85% application, 15% accumulation formula, after all this adjustment, your income was say 3 lakhs or say 3,50,000. Now, without considering your capital commitment of 5 lakhs, your income is 3,50,000. Your 3 lakhs is the basic exemption today. So you are short of only 50,000 rupees. As a measure of tax planning, I will recommend you to claim out of these 5 lakhs, only 50,000, only a part claim. I have got some tax planning in my mind so far as these 5 lakhs is concerned. I was short of only rupees 50,000 so that I am not required to pay any tax on my income. This income I computed without claiming this 5 lakhs capital expenditure as a part of my application. I was short of only 50,000 rupees. So, what I will do, I propose to do, I recommend you to do, to claim only 50,000 out of 5 lakhs as an application on the objects. What will happen? Your cost of 5 lakhs will be divided into two parts. 50,000 claimed as deduction, 4,50,000 not claimed as deduction. I will continue to claim the depreciation on 4,50,000 in future for all the years up to the time this piece of machinery is in my record, is in my possession or in my use. To my mind, my whatever little study of the Income Tax Act, especially section 11(6) is concerned, I have got. It doesn't talk of 100% cost claiming. It says cost of asset. It doesn't say full cost of asset. There is a difference between cost of asset and full cost of asset. In absence of any provision to the contrary, I will take only 50,000 rupees as an application. I have a strong support in this case. Old regime. I deposit 2 lakhs under section 80C. 1,50,000 in public provident fund, 50,000 in my life insurance policy payment premium. Income tax act doesn't prohibit me from making 80C contribution above 1,50,000. It says you pay 2 lakhs. It only says maximum deduction is 1,50,000. Similarly, taking clue from this, as a measure of tax planning, I feel, and I think this being a fiscal law, this will be interpreted to the benefit of the taxpayer because this is a beneficial provision. 15% depreciation disallowance. It should be disallowed only on 50,000, not on remaining 4,50,000. This is so far as part of depreciation accounting issue from the point of view of the management is concerned. And now I am coming with a very innovative approach so far as separate financial statements for the purpose of Income Tax Act are concerned. For this purpose, I will briefly touch on provisions of Section 12, which imposes large number of restrictions on amounts to be claimed as an application. I will also refer to Section 11 also. What Section 11 says? 11(1)(a). Out of your income from the property held under trust, Section 11 and 12, it says you are required to apply 85%. It doesn't say maximum 85%. It doesn't say more than 85%. It says you are to apply 85%. 85% application implies that you have unrestricted right to claim 15% as a standard deduction for charitable purposes in future. So, if your income is say 5 lakhs, then 85% of 5 lakhs application should be 4,25,000 rupees only. And you are legally bound to claim 15% as an application. This 15% application is also a measure of a tax planning that I am trying in my office. I will deliberately go to this 5 lakhs again. My income from property held under trust 5 lakhs. So my 11(1) restriction is 85%, 4,25,000. In other words, 85,000 is my legitimate accumulation claim. Now, for a moment, I assume that my actual application is 4 lakhs. Then I will have to submit Form 9A or Form 10 for 25,000 rupees only and not rupees 1 lakh. Because 15% is my statutory right that cannot be taken away by assessing officer or by the CIT in any way. What Act prescribes is that, what Section 11(1) prescribes is that 85% application. So out of 5 lakhs, 85% application comes to 4,25,000. My actual application is 4 lakhs. So I will be required to accumulate 25,000 under Form 9A and Form 10. This is so far as the information or the management is concerned. I was talking about the separate financial statements under Income Tax Act. I will take my balance sheet as on 31st March 25 as my base, and based on my audited balance sheet of 31st March 25, I will prepare separate balance sheet for income tax purpose only, where my returned income will be equal to my net surplus as per my books of accounts. So here what I will do is that I will try to see to it that the figures disclosed in my statement of total income are repeated in my income expenditure account as I am showing part of my income and part of my application and accumulation. My income, Section 11 and 12 has got 3 parts. One, income received from the property held under trust. Number 2, accumulation. Number 3, 85% application. And if 85% application is short, 9A and 10 accumulation, deemed income. So my income under the Income Tax Act has got four parts: property held under trust income, then 15%, then 85%, 85% in two parts: actual application, deemed application. All these four parts need to be disclosed in my income expenditure account that I prepare under Income Tax Act separately after my financial audit is regularly over. What I will do? 15% accumulation, that is my birthright. And like Honorable Lokmanya Tilak said, freedom is my birthright. So 15% is my birthright. Fortunately, that right is continued in the 2025 Act also. So now there is no restriction on 15%. So I will pass one simple entry in my books: income and expenditure account debit 15%, and my separate reserve of 15% compulsory accumulation reserve. Simple. So if my P&L account credit side I have got say 5 lakhs, my 5 lakhs will be there on the 85,000 will be on the debit side. P&L will be debited with 85,000, 15,000, saying that statutory reserve created 15,000. This is for income tax purpose only. This has got nothing to do with our regular audit, say for ROC or say for charity commission. This is for your internal working. This is for your presentation before the assessing officer for preparation of your statement of total income. Now, comes the issue of 85%. So far, this 85% concerned is your application. We have already seen that out of that 5 lakhs my income, 4 lakhs I have already spent. So what I will pass that entry? Application account debit 4 lakhs to my income expenditure account 4 lakhs. So on the debit side, I have got two accounts: 85% 75,000 application, 75,000 application, then 4 lakhs actual application, and now you have shortage of 25,000. There you will say Form 9A or Form 10A accumulation 25,000. So this way we should prepare. We are trying to prepare in our office. This is a new exercise we are doing. 85% application separate accounting, 15% accumulated reserve separate accounting. And before this, we have two issues: expenses which are inadmissible because the expenses were paid in cash above rupees 10,000 or for some other reason. If they are inadmissible, naturally that will not form part of my application. So they will be totally inadmissible. So that time I will say inadmissible item, that will be my separate group. There are two more cases: depreciation which is inadmissible. So that will go at par with my inadmissible expenditure in cash. But there are two more special provisions. One, provision of the current year which I have not paid in cash. So I have, for example, I have made provision for salary of 10,000 on 31st March 25 and paid in April 25. So this is a provision which is not admissible today, but this will be admissible in the next year. So this I will take it under that provision inadmissible in 24-25, admissible in 25-26. So for the purpose of determining my 85%, this provision will also be considered. Similar formula I will apply so far as my previous year's no TDS cases are concerned. Like my provision which is not allowed as a deduction, we will also make the same accounting for expenses for which through oversight we have made no TDS today. For example, there was a professional fee payable of rupees 60,000 and through oversight there was no TDS made because it is above 50,000. Now naturally this will be disallowed. So this will be disallowed for the current year. But after depositing the TDS on the 60,000 in say April 25, this will be allowed as a deduction in 25-26. So there will be disallowance either totally or short period. Some deduction will be inadmissible on perpetual basis. that is timing. And some deduction will be inadmissible only for the current year, but will be admitted in the subsequent year when the provisions of the act are fulfilled. So this way, we will try as a permanent record. We will try to prepare a balance sheet in the books of accounts separately apart from our financial statements. Friend, we are aware that if there is inter-trust donation, similar objects, then that inter-trust, I am not talking about corpus, I am talking about inter-trust donation. Then inter-trust revenue donation is inadmissible to the tune of 15%. So like that, accumulation 15% or inadmissible depreciation, this 15% inter-trust donation is inadmissible. That will be a perpetual disallowance, and that will also be disallowed while finding out that 85%. And all this we will do so far as our determination of 85% application is concerned. So on the one side, we will have firstly the income, P&L account credit side or the income expenditure account credit side, standard deduction, my birthright 15%, and then remaining cases, inadmissible depreciation, inadmissible 15% interest permanently these will be disallowed, and then provisions and TDS cases disallowed for the current year but admissible in the next year. Now, so far as these TDS and provisions are concerned, these TDS expenses may be of not only 24, 25, maybe of 23, 24, where the TDS was not paid in 24, 25, but you paid in 25, 26. So far as the previous year is concerned, if you see my heading so far as TDS is concerned, I have written TDS previous years, but not TDS current year. So previous year, I mean all the previous year before 24, 25. So far as inter donation, permanently disallowed expenses, non-cash without non-cash mode, permanently disallowed. So taking into account all these factors, we will try to prepare separate financial statement, and that will match exactly with our returned income. This is so far as separate financial statement for the purpose of Income Tax Act is concerned. This is so far as incorporation and management is concerned. Coming to the conclusion, so far as management part is concerned, I would like to recommend you to maintain a due date register so far as the NGOs are concerned. Why did I feel the necessity to maintain the due date register? Friends, we are aware Section 12A now prescribe that the registration available to the smaller trust having income without application of Section 11 up to rupees 5 crore, that tenure of approval is tenure of registration under Section 12AB is 10 years, practically 9.5 years, because you have to apply 6 months before the end of expiry of the period. Now we are in a regime where all the registration those were given under new trust regime in April 21, and they are going to expire in March 26. 30th September 25 is the last date to apply for renewal of our approval or our registration. And from this 30th September 25, 10 years period will be counted 30th September 35, where the smaller trust will have a duty to apply for renewal of its registration. Friends, fortunately, under the new act, registration term is used for section 11-12 cases, and approval term is used for section 80G cases only. Under the old act, approval was used for two types of cases. I don't know why this type of confusion was there. But under the old act, section 1023C, in place of registration, approval term was used, and same term was used under section 80G. In my considered opinion, under old act also, under section 1023C, they should have also used the term registration like under section 11 and 12. 1023C and 1112 are just real brothers and sisters, and both have got relationship to section 80G. In the light of this practical thinking, I thought it fit that there should have been a registration under section 2023C under old Trust Act. But fortunately, this lacuna they have corrected in the Income Tax Act 2025. There, so, and fortunately that 1023C 15 entities and one entity covered by section 1112, all they have merged together. Now we will have registration for 16 entities under new tax regime, new 2025 Act, and also 80G if applicable for all under new tax act. All this discussion I made for the simple reason that under the new act, next registration for smaller trust will fall due on 30th September 35. Friends, you imagine the seriousness of this particular issue. Normally, we have the managing committee or the board of trustees rotating from year to year or after say period of 2 to 3 years. And now what will happen after 10 years, we cannot imagine. And therefore, at the very beginning, I said that unless and until you have got stronger infrastructure, we should not venture to incorporate a new entity. Now, in fact, it was my expectation, very small and humble expectation from the income tax department. When they have got a very strong software, like they are sending the notices for filing of the income tax return, income tax department should have started on 1st April 25 itself to all the trust whose approvals are due for renewal on 30th September 25. The department should have issued the notices to all such. Department has got this data to whom they have given the registration and approval up to 30th March 26. So without waiting for 30th September 25, department should have voluntarily came forward as a part of service to the tax-paying community that your renewal is due. We find that banks are also sending us the renewal notice for renewal if their FD is maturing. With such a strong software at its disposal, it is very simple expectation from the income tax department, from the CVDT, that it should have reminded all the trust as a part of simply city to do ease of doing business. Department should have sent reminders to us that your renewal of 12A and 80G is now due on 1st of April 25. File your application in 10AB before 30th of March, 30th of September 26. Forgetting the issue of income tax department. In fact, it should be a part of charter of income tax, charter of SSS under section 139. This is casting one more duty on our shoulders to apply on 30th of September 2035 for renewal from 1st of April 26. And if you fail, your registration or approval will be cancelled and you will be caught within the clutches of 115 TD presently. The same provision is continued in new act also. So friends, so far as management of the NPOs is concerned, we should have a due date register. Fortunately, we are in ITH. So with the use of AI, we can have use of information technology, and technically we can maintain a due date register so that by due date it will remind us. I don't say on due date, it will remind us, it should remind us sufficiently in advance before the due date of our duties. And also, I would recommend you to maintain and preserve in a separate custody our permanent records. Friends, managing committee is always a floating body, especially in case of real public charitable trust, where the members of the general public assume the office of trustees. Family run public charitable trust, that will not be a serious issue. But family run public charitable trust, non-family run public charitable, where outsider other than family members are coming to the position of board of trustees. This is very important. So our permanent records like registration certificate, memorandum and article, our lease deed, property purchase deed, building construction plans, proceeding books, all such important documents must be reserved permanently. As a measure of abundant precaution, we can preserve them in a safe locker in the bank, or also we can have its copy loaded on Cloudways, or also you can have it on email of somebody so that it can be made available at the time you require. One more small professional issue, not now coming to the management, but I am coming to my professional colleagues. There are complaints while our fees are concerned. The including myself, I am having the charitable trust. They say, sir, ours is a charitable organization. You give us some concession in your fees. We are out of position to meet our both ends. Friends, I know my duty as a citizen to my country. Whatever is permissible to me by my pocket, I will definitely do for my most beloved motherland. But we must also honestly bring it to the notice of the office bearers of the trust that we will definitely share a squirrel share in your activities. But our office is a commercial organization. We have our fixed assets, fixed expenses, except credit card. No credit is available enough, even if our community is a very respected part of the society, very cream part of the society. As a chartered accountant, especially as a practicing chartered accountant, we do enjoy a great respect in the society. But nobody gives us a credit except and concession in our charges, neither a credit nor a concession in our expenses. ICI fees are due on 1st April. Our all license fees are due on 1st April. Our mobile expenses are paid in advance. Our all other expenses are always required to be paid in advance. Our petrol we are required to pay on the spot. Our staff salary we are required to pay latest by end of the month. So we neither delay our payment, nor we ask our staff to reduce the payment because we are rendering services to philanthropic society. We are to run our show at our cost. So my humble appeal to you will be, we may bring it to the notice of so-called NPOs that while we will definitely share a spiritual share, some member may say that, okay, I will do your job free of cost, depending upon the relationship and other factors. Practically speaking, if you are having some industry as your client, and if the industry asks you to do their CSR trust on honorary basis, because of practical situation, you may do it free of cost. But this formula will not be applicable in every case. So my humble suggestion will be, do take a call on your rate of fees so far as your relationship with your NPOs are concerned. Finally, one more national level issue. We have got the laws for NPOs at the state level. So far as the NPOs at national level are concerned, not necessarily working at the national level, but having objects covered under the Society Registration Act, they are covered by the Society Registration Act. But there are other non-society entities like say religious trust. They have the laws at the local level. Say in Maharashtra, we have got Bombay Public Trust Act that caters to both charitable trust as well as religious trust. But the Society Registration Act, which we have in Maharashtra, is not applicable to the charitable trust. So, for the purpose of uniformity at the national level, I have just a thought in my mind that like the societies, those are covered under the Societies Registration Act, we professionals may think of recommending our institute, and our institute may think of recommending to the central government to form a separate law so far as other non-society entities are concerned. I will cite one example. In Maharashtra, we have got Maharashtra Public Trust Act. Same act is in Gujarat also. Because we were together before our bifurcation in 1960, Maharashtra and Gujarat were together. But now we find that whatever provisions are there in Maharashtra Public Trust Act are not at par with the provisions contained in Gujarat Public Charitable Trust Act. So, in order to introduce the element of uniformity at the national level, we may recommend to the Central Council. Central Council may think over it and may recommend to the Union government to design a separate law for the entities. Other than entities, those are covered by the Societies Registration Act. Friends, I was given a time of 2 to 4. I am really grateful to the NPO committee, CA Abhijit Chariot, CA Praveelji Jain, CA Nirupamaji, CA Anjali Sharmaji, Vasudevji, and all the members of my pious profession. Thank you very much. It would be my great pleasure to answer your queries if you have got any. Thank you very much.
I would request the members to please pose their questions.
They can, if they have got any query, they can have no problem about that. Manmanji, if anybody has got queries, let them.
Yes, sir, I'm checking. I'm requesting members to pose their questions.
Yeah. I have got one more small point. We have a protocol for our national anthem. Very recently, Vice President of our institute visited Pune. At the beginning of each program, we rise for the motto song of our institute. We have got highest regards like national song for the motto song of our institute. I have recommended earlier council also before the present council, and I met Vice President personally in Pune when he happened to meet the members in Pune to prescribe a protocol for the motto song also. I have experienced that with due respect to my members, that they stand up in a very casual position while the motto song of our institute is being sung. So my humble suggestion to our the members also will be that through your central council member, you may recommend to the president of the institute and central council to prescribe a motto for our motto song strongly as a matter of our profound respect for that motto song. Thank you very much. If there are no queries, we can wind up.
Yes, sir. If any member has query, please post. I think there are no questions yet,
Yeah, that
sir.
is what I'm saying.
Thank you so much, sir, for
Thank you.
such valuable insights into the topic. Yes, sir. Thank you so much on behalf of the committee. Thank you all the members for attending today's event.
Manviji, what was the number present today?
So that tech support can only update. I don't
Okay.
have
Okay.
details.
Okay. Okay. Pardon me. 500 and Manviji, please share your personal number also to me. Shall we wind up now?
Sorry, sir.
Shall we close now? No queries.
Yes, yes, yes.
Vasudev, I think we should now wind up. Huh? So shall I leave now?
We can end the session. There are no questions yet.
All right. Manviji, you please share your mobile number to me on my number.